Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Inflation positioning European stocks mostly track Wall Street higher before today's crucial U.S. CPI report. Japanese Prime Minister Fumio Kishida nominates Kazuo Ueda to lead the BOJ, paving the way for a shift towards more hawkish policy. The yen gains. And shares in Norsk Hydro, one of the world's biggest aluminium producers, are lower after the company missed estimates in the fourth quarter. We'll hear from the company's chief financial officer later this hour. Now, first thing is first, and it is a big day for markets, not only US CPI, but of course everything that's happening at the BOJ. So let's kick off and looking at the markets. Stocks pretty much edging higher. This is all ahead of that US inflation reading. If you look at the yen, and this is the BOJ, of course, announcement, the yen strengthening against most G10 currencies after the government made the BOJ announcement. It's very clear when you look at charts and maps that traders have recently increased bets that the BOJ's yield curve control and negative rate policies may be abolished soon under Ueda's leadership. We actually spoke to someone from formerly Bank of Japan that knows Mr. Ueda intimately, and he says, look, it may not come as soon as markets are pricing in. The European map, let's see if there's a huge difference between some of the sectors on the move and certainly some of the countries on the move. It doesn't feel like it is, although we do have some really interesting signs here in the UK. UK wages rising more than expected, in the added sign of inflation. And then we also have a Bloomberg survey. We'll get our economists actually on this a little bit later on, saying that a lot of workers, certainly in London, want a 16% increase to come back to the office instead of working from home. Now, economists are expecting a 6.2% year-on-year print for US CPI data when it comes out later today, with a 0.5% increase month on month. Bloomberg Economics, though, thinks that reading will be hotter than that due to an increase in energy prices, slowing momentums in good disinflation, and still robust gains in service prices. We're now joined by Alex Brazier. He's deputy head of BlackRock Investment Institute for many years, also at the Bank of England. So you know and understand inflation and the obsession with inflation quite intimately. What are you expecting from CPI? And good morning.
Well, that consensus view that you described seems reasonable, but there's a lot of uncertainty in this environment, not just about the month-on-month change, but about where inflation's tracking over the year as a whole. You listed some of the forces at play there. We've got energy prices stabilising, we've got goods disinflation. But most importantly, and the thing that's going to control where inflation ends up settling, is that core services inflation, which is really driven by wage growth. We've got very persistent wage growth in the US economy, as we saw this morning in the UK economy. And that's ultimately going to mean, in our view, that inflation's a little more sticky than perhaps markets have been pricing in. But there's a range of possible outcomes here.
So, Alex, how do you see it? That it's coming down, so we don't have that red-hot inflation anymore, but then how sticky is it to get it down? Does it actually warrant many Fed hikes?
Yeah, I think possibly the Fed will need to keep rates higher for longer, and you see the rates market beginning to price that over recent weeks. The interesting thing is inflation's coming down driven by goods disinflation and energy prices. Getting down to 4% seems a done deal. The interesting thing is, can it go below that without the Fed crushing demand in some way? Now, it's possible, and the market has begun to place a lot more weight on that over the course of the year. But it's very possible it doesn't. With a very tight labour market due to labour supply constraints, that wage inflation is really the thing to watch rather than the month-on-month CPI prints.
And Alex, and actually, we have some really great charts. We have core services versus core goods year on year. We have the wage growth, which we'll get to that in a second. Overall, how much of this slowdown that we've seen so far from that red-hot inflation is due to monetary policy readjustment?
Very little, actually.
Okay.
I see two forces happening so far. One, of course, is the stabilisation of energy prices.
Yep.
The other, though, is the disinflation in goods. So during the pandemic, we saw this huge surge in goods prices as we all stopped spending on services and started spending on goods instead, and that's what caused all the bottlenecks and supply constraints. That surge in goods prices relative to all other prices is now unwinding. Now, the process is pretty bumpy, so there's a lot of uncertainty about where we go month to month. That's going to drag down on inflation this year, but that is, to use an old school phrase, a transitory effect. And what happens after that will be dictated by where services inflation is, and that depends on where wage growth settles.
But have we lost control of wage growth? So it's not, you know, there always is a bit of a mismatch. If there's a wage spiral to the upside and people want and think they're own, then you kind of lose control.
Yeah, it doesn't look like the US or other economies are actually in a so-called wage price spiral right now. Wage growth is pretty strong. It reflects a tight labor market. You look at the US, an unemployment rate of 3.6% has always, in the post-war period, been associated with strong wage growth, even adjusting for where inflation is. So this isn't in many ways a surprise. The big question is, does wage growth ease as inflation comes down of its own accord? And that's possible.
Yeah.
But it's more likely that wage growth is pretty stubborn amidst this tight labour market. And as a result, the Fed needs to keep rates higher for longer to squeeze that labour market pressure out and get inflation all the way down.
Where do you think, Alex, we end up with in terms of the terminal rate for the Fed?
Well, a terminal rate of around 5.25, which is where the market has been on a round trip, but it's got back there, seems pretty plausible. I think there is a risk on the upside to that, though, which is if the economy doesn't slow and proves pretty resilient to that level of rates, which is what the equity market got quite excited about.
Which is what we've seen so far, right?
And has been the case so far, actually tells you the Fed needs to do more in order to generate the kind of slowdown that it may need to see to get inflation all the way down. And so this is what I mean by considering the full range of scenarios for the year. This is an environment with no playbook. And so investing in this environment requires considering all the possible scenarios we're faced with.
But the possible scenarios are what, 4 terminal rate up to 5, or are we? I mean,
well,
how much do you think we're misjudging
If 5.25 is the central view,
right,
there are risks on both sides of that. One is on the upside, where it turns out the economy is more resilient to these rate hikes, but the Fed still needs to crush activity to get inflation all the way down.
6%?
In which case, you need to go even further.
Okay.
That's not my central case, but I think that is one of the scenarios that has to be on the table. The other is that the Fed goes a little further, and that does slow the US economy, but inflation does come down largely of its own accord. That's a possibility as well. And this is a really uncertain environment. And that's why you need to consider all those different outcomes.
Yeah. Alex, the other big story is, of course, Joe Biden poised to name Lael Brainard as his top economic advisor. I mean, that means there's a vacuum at the Fed. Like, how does that shift the dynamics? Well,
one of the there are many central bank appointments today as well. We're going to come on to those. These central bank appointments get a lot of headlines, or in this case, a central bank unappointment. But actually, it's the economic circumstances that dictate where central banks end up going. They are controlled by the forces around them. And in the Fed's case, the thing they're focused on is this thing we're discussing, which is wage growth going to be persistent amidst a tight labour market, or will it ease of its own accord? And the signs are in the labour market this tight that we could see much more persistent wage growth.
Alex, and we are speaking about the BOJ shortly, but there seems to be market movements that almost, are trying to force central banks' hands. And this could be Fed, but it's certainly the Bank of Japan. Are we underestimating? Like, is your money on what the markets are thinking overall, because central banks actually don't want to disappoint? Certainly not like they did maybe a couple of years ago.
I'm not sure about that. I think in this case, the central banks are focused on getting inflation down. Yeah. The big uncertainty, though, including for them, is how much they need to do that. Now, in our view, they will need a slowdown. The tightening they've put in train will generate that slowdown and a recession. And as a result, they will get inflation further towards their targets. But it won't be a kind of pleasant, immaculate process.
But the market's not seeing that.
Yeah, and over the course of the year so far, the market's been placing increasing weight on inflation coming down of its own accord, the economy being pretty resilient to rate hikes. And that's possible. But a lot has to go right in order for that to happen. And these other outcomes of, well, if the economy does prove resilient and the Fed has to go further and raise rates higher, have to be on the table, as does the possibility that inflation doesn't come down of its own accord and the Fed has to keep rates north of 5% for quite some time.
Alex, do you think there's an optimistic bias in markets in general because of the last 10 years and what we lived through?
I don't know about an optimistic bias in general, but certainly in January, we saw increasing weight being placed on this good outcome of inflation coming all the way down of its own accord, growth being sustained despite these rate hikes. It's possible, but the risks to that outcome are certainly in one direction.
All right, Alex, thank you so much. Alex Brazier, Deputy Head of the BlackRock Investment Institute, stays with us because we talk Bank of Japan and Bank of England next. Coming up, Kazuo Ueda has been nominated by the Japanese government to lead the BOJ. So we'll discuss what that means for the yen and the end of the yield curve control. That's coming up next, and this is Bloomberg.
he may change his policy if the Japanese economy gets overheated, which is expected at this moment. He might, be in a position to tighten the monetary policy rather than continuing to ease the monetary policy.
Well, Japan's former vice finance minister, known as Mr. Yen, on possible changes in BOJ policy. Now, staying with Japan and the news that Kazuo Ueda will lead the Bank of Japan. Bloomberg Intelligence thinks he would bring a slightly more hawkish tilt to the central bank, but not an abrupt exit from yield curve control. Well, Alex Brazier, deputy head of BlackRock Investment Institute, many years at the Bank of England, joins us again. Thank you for sticking around, Alex. When you look at, first of all, the policies, right, of someone who talks as a non-insider, how much do they change? Like, we know a little bit of what Mr. Ueda is thinking at the moment. I mean, could he, pivot significantly when he's in charge?
Yes, I think so. Although it's less about the personality, as we said before the break, and more about the fundamentals that this new governor finds himself in. Japan, for many years in deflation, following an inflation surge, that picture's now changing. Now, you have to be a little bit cautious because a lot of that inflation surge was driven by energy price pass-through and very strong import price inflation following the yen depreciation. So it was transitory. But actually, the important thing for the Bank of Japan now is that it's becoming more embedded in wage growth. We've seen that pick up in wage growth, which changes the picture pretty decisively, in our view, and means that the Bank of Japan has achieved its stated aim. Wage growth isn't a problem in Japan, it's part of what they're trying to achieve. And so that yield curve control policy can, over time, be loosened and abandoned.
Over time is probably the key word. Are the markets thinking that it comes quicker than you think it does?
It's very difficult to get the precise timing. But what you do know is that when it happens, it could be disorderly. Right. In the same way that changing a currency peg is always disorderly. The swaps market is anticipating this change, but when, and I don't think it's a case of if, I think it's a case of when the Bank of Japan changes its yield curve control policy, and it may do so in a sequence of steps. We could see the long end move up very sharply, and we could well see that spill over to developed market long-duration bonds as well. And that's one of the things that keeps us a little bit cautious on long-duration bonds. So
if you look at maybe less than timing, but the fact that they could do it in steps, would that make it less disorderly? Not necessarily, because take, for example, the idea that has been floated that they move from controlling the 10-year point to controlling the 5-year point of the yield curve. That's a step towards abandoning yield curve control. You still see the 10-year move very sharply at that point. You look at where swap rates are now to give you an indication of that. So when you abandon these things, the move is by definition sudden, and that runs then the risk of creating spillover effects. So how do you play it at the moment? Is there a way to play it, cautiously? Well, I think for us it means a couple of things. The first is that we underweight Japanese long-term government bonds. We are also bringing Japanese equities into line with our view on developed market equities more generally. We don't see a reason to favour Japanese equities in this sort of environment where the policy could be released. And as I say, it's one of the factors keeping us a little bit cautious about longer duration government bonds more generally in developed markets. Alex, we also spoke, quite intensively about, of course, the Bank of England. We had a couple, actually one MPC member, I think yesterday, saying, Brexit has cost £1,000 per household. Like, how do you view the Bank of England dynamics where we are? People are much more upfront about what they think the Brexit impact is. Does it make a difference on how they set policy? I'm not sure it does, actually. And it's very difficult to disentangle the effect of Brexit, the energy shock and the pandemic, all of which are very big supply shocks in their own right. So I don't know how you attempt to disentangle those things. But what is clear is that the UK is a kind of microcosm of developed markets in general at the minute. Inflation's coming down as energy prices stabilise and goods disinflation takes hold. Wage growth, though, is still very strong, and services inflation is very strong. That reflects a tight labour market due to reduced labour supply. It's exactly like the other economies. The UK probably, therefore, needs a recession to get it down, probably a deeper one than others because of weak productivity growth, and that's what the Bank of England thinks it's going to achieve. You look at its forecasts, and they don't include a deep recession, but very strikingly, they pencil in no growth over the period from the beginning of last year to the beginning of 2026. And that, that overall is a very big recessionary period. But is the labour market much tighter here than in other parts of the world?
I think it's as tight,
Okay.
but not necessarily much tighter. The UK, like the US, has experienced a big labour supply shock, partly due to demographics and partly because the pandemic accelerated the retirement of a whole cohort of people. So even though employment isn't high by historic standards, the labour market is tight. You've got low unemployment, you've got high vacancy rates, all of which is adding to wage pressure and making it difficult for the central bank.
Alex, thank you so much for joining us today with, of course, a lot of insight on US CPI, on the Bank of Japan and the UK. Alex Brazier, Deputy Head of the BlackRock Investment Institute. Now, coming up, nearly 3/4 of London workers would rather quit their jobs than return to the office full-time. We'll bring you more from our research next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's our daily UK segment. Now, nearly 3/4 of London workers, I love this story, nearly 3/4 of London workers would rather quit their jobs than giving up the flexibility to work from home. Now, a survey by Bloomberg Intelligence found 4 in 10 would need a raise of at least 16% to reconsider their position. Now, here with me, Sue Munden from our Bloomberg Intelligence team. Sue, I have to say, no one could pay me enough to actually stay at home. I love being in the office. But what's the rationale, first of all, behind the survey?
Well, we wanted to get the employees' perspective on this. Obviously, work from home is a big issue. I do real estate, and all the big London REITs who tend to have the big multinationals as their tenants in prime space tell us what they think. But I thought it would be really important to get a much broader perspective by having a survey. And we surveyed 500 respondents about a week ago and asked them these questions. So what would it take for you to go back to the office full time? And so on. And so we've learned quite a lot from the survey. We can go through some of the results if you like.
Yeah, I mean, the results are pretty amazing, actually. And it kind of points to the fact that people, want 16%, which is not insignificant in terms of rate rise. But does it mean that work from home is here to stay?
I think it really is. 95% of the respondents said that their offices already give them work from home. 70% of the respondents said that they think it's here to stay, that they actually believe that it's a permanent fixture. So yes, I do believe it is. And also, out of that 73%, what we've seen is previously the elder generation only in June, because we did another survey in June, they'd said that about 44% of them wanted to have permanent work from home or those flexibility. Now that's gone up to 77. So that 73% now is a very, very small variance between the age groups.
And so do you think it's London, because it's London, so it's also more expensive, the commute is more difficult, or is it just a lifestyle?
Yeah, so there was a chart that we had that showed the reasons why people wanted to come back to work and why they didn't, why they want to stay at home. Obviously, rail strikes, costs and all that sort of thing. Coming to the office, salary increase was high up there, but also things like networking and the knowledge transfer for the younger staff and so on.
So we got UK jobs data today, and
we did,
that's quite a big one. Any implications that you saw in the survey for that?
Well, I think the sort of confidence that the respondents had may come from the fact that it's a really tight labour market. And being a tight labour market, they have the bargaining power. So they're sort of perhaps pushing their price up a bit. So, pricing the return to the office at that level is quite big. So, yeah.
Yeah, and frankly, if you have good employees, they should be flexible if you want to retain them. I mean, you can give them what they want. It's not, it's not rocket science, right?
Yeah, retaining talent in the UK is quite hard, especially in London.
It's probably the biggest job.
And also, actually, the cost of the office is quite a small proportion of the total cost for anyone who's renting an office, and the labour cost is the big thing. So you can actually see that for smaller businesses, they probably prefer to tell their employees, go work from home and we'll top up your salary, which talks to today's data as well.
I mean, I wonder whether if you move from London, do you get and I know a couple of chief executives were talking about this, if you move from London, do you then get a decrease in salary because it's cheaper to live elsewhere? Tricky
It's
one.
always usually been the other way around. You just get paid more when you come to London. So whether they're going to be able to reduce people's salaries is quite a difficult thing to do.
Yeah, again, I'm not head of HR, but you're right. If you want to keep your talent, usually do not offer them less money if they want to work from home. Sue, thank you so much.
Thank you very
Sue
much.
Munden there for our Bloomberg intelligence team. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. So we'll have great reports. Of course, our team of UK anchors and reporters will be joining us to make sure that we cover all of the top stories. This is a picture overall for European stocks. So they're edging higher before that key U.S. inflation data. Overall, they were they were actually a little changed this morning. The other piece of news is that we saw a drop in wage growth expectations easing in the U.S., the yen rising following the formal nomination of Kazuo Ueda as the next Bank of Japan governor. Coming up, shares in Norsk Hydro slump on the back of an earnings miss. We speak to the CFO next. This is Bloomberg. Inflation positioning European stocks mostly track Wall Street higher before today's crucial U.S. CPI report. Japanese Prime Minister Fumio Kishida nominates Kazuo Ueda to lead the BOJ, paving the way for a shift towards more hawkish policy. The yen gains. And shares in Norsk Hydro, one of the world's biggest aluminium producers, slump after the company missed estimates in the fourth quarter. We'll hear from the company's chief financial officer in just a few minutes. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Norsk Hydro has reported a sharp drop in aluminium demand in the fourth quarter, clouding the outlook for the Norwegian firm at the end of a record year. Quarterly sales of extruded aluminium products sank 12% from a year earlier as orders from the construction and industrial sectors fell. Well, we're now delighted to be joined by Paul Kildemo. He's the CFO of Norsk Hydro. Paul, thank you so much for joining us on Bloomberg. What do you attribute this downturn to? Monetary policy trying to slow economies, or is there something else more sinister out there?
I think the downturn is driven by a combination of elements. The inflationary pressure that we've seen from high energy prices really started the whole downturn, basically reducing the end demand. But that has now been replaced by, as you say, measures to try and curb this inflation. But I would like to say that if you look at what we see now compared to what we did only a quarter ago, demand actually looks a bit stronger for aluminium on the back of the changing situation we see in China.
But, Paul Kildemo, give me a sense of exactly what China means. So, what impact are you specifically seeing from the China reopening? How much is the downward effect and transitory, and how much of it is deeper?
I think as a starting point, it's mostly sentiment driven now, and that's what's gotten up prices. The reason why the Chinese balance is a bit tighter is because they've had to curtail a certain amount of capacity also. But if you look into half-year figures, then you see more stimulus-driven demand potentially picking up the global economy through China for aluminium.
But what does it mean for European smelters that are already struggling with the cost of inflation and, of course, higher energy prices and, trying to see the economic downturn, the effect it has on them?
Yeah, so for energy smelters in Europe that don't have long-term power contracts, it still looks challenging. We haven't seen a lot of restarts apart from the state-subsidized ones since the energy prices came down. And even at the lower levels of energy prices today, with the higher aluminium price that we're seeing, it doesn't make sense to restart European curtailed capacity. And we actually still see around 600,000 tons at the risk in Europe that would potentially have to curtail if prices rise again on a cold spell or similar.
So you have more employees in the U.S. than any other Norwegian company. What's the impact of the Inflation Reduction Act on your capacity? Do you want to increase capacity in the U.S.?
Well, it looks more attractive to do adjustments to our portfolio in US versus Europe, unless Europe really gets something to match, especially on the renewable energy and renewable technology side. We are an aluminium company, but we also have a hydrogen unit, and we are looking to gradually replace gas in our cast houses and other processes with hydrogen. As it stands today, this looks much more attractive to do in the US than in Europe. And that is probably where one would start if one looks at the pure financial fundamentals.
But what's needed from the EU to make sure that production capacity of all things, of aluminium, but also hydrogen, doesn't move to the US and actually stays in Europe?
Well, I don't necessarily see that aluminium production in US is a big competitor to Europe as we see it now, based on the energy market. But I think to ensure that we maintain energy capacity or aluminium capacity in Europe, it's important that we continue to focus on creating a global playing field. Keep CO2 compensations in place until you get the CBAM fully up and running, a fully functional CBAM, which leads to the intended effects. When it comes to more new technologies, then of course Europe needs to provide something which matches what the US has come up with if they are to be able to compete to the same extent. We're seeing promising developments now in the proposals that are coming out, but they're still too generic and not specific enough to make investment decisions on the back of.
Paul, at the same time, the U.S., we understand, is planning to extend some 200% tariffs on Russian aluminium as soon as this week. Now, we understand that the President Biden, has yet to give the official go-ahead on this move. But what would that mean for, European aluminium producers in general?
At the moment, there's not that much Russian aluminium that flows into the US. And the fact that US puts in place tariffs doesn't necessarily impact the broader market. I think people that were looking for a more positive price reactions, who were hoping for sanctions, that sanctions would be broader and they would be more challenging also to trade aluminium outside the US. So there's positives and negatives on this, but I think in general, the consensus is that this is quite a non-event.
I mean, I think you've been keen to expand in low-carbon aluminium. Can you tell us a little bit more about what kind of demand you're seeing for that?
Yes, this is really what the company is all about. We work throughout the value chain from bauxite and alumina to extrusion to ensure that we can deliver the lowest carbon aluminium. And when you look at general demand for aluminium, it's about 3% year over year. But if you look at low carbon aluminium at 4 tons of CO2 and below, we expect demand of 20% year over year. And if you look at our sale of greener products this year compared to last year, even with the weakening Q4, we're actually up 60 to 70%. So this is the market for aluminium where we see the biggest margin potential going forward.
Yeah. Paul, I also need to ask you about this class action suit against Norsk Hydro in the Netherlands. And this is about a smelter, or actually a refinery in Brazil, that they allege has been damaging and polluting in the surrounding community. What does this mean for Norsk Hydro?
Well, these are cases that has been going on for a very long time in Brazil, which are now moved to the Dutch court system. And we have a high focus on being a good neighbor. And we had our issues back in 2018, where we had to curtail our refinery. But at the end of the day, it was proven that there was no overflows or nothing that shouldn't have been done that was done. So we will handle this lawsuit in Netherlands as we do in Brazil going forward. To be a provider of low carbon aluminium, you need to focus on more than just climate. We need to focus on environmental and social, and we are really doing that in Brazil these days.
Yeah. Paul Kildemo, thank you so much for joining us, Norsk Hydro Chief Financial Officer. Now let's get straight to the first word news with Simone Foxman in Doha. Hi, Simone.
Hi, Francine. Bloomberg has learned that U.S. Secretary of State Antony Blinken is considering sitting down with his Chinese counterpart Wang Yi, the first meeting since the downing of a balloon over the United States. Sources say the two would meet at the Munich Security Conference later this week, if both sides agree. The U.S., meanwhile, has recovered what it calls significant debris from the remains of the balloon shot down off the coast of South Carolina last week. New Zealand has declared a national state of emergency as Cyclone Gabrielle brings flooding, landslides, and power outages. Tens of thousands are without electricity, with many roads closed in northern regions. Auckland Airport says 45,000 travelers have been disrupted due to flight cancellations. President Biden is said to be poised to name Federal Reserve Vice Chair Lael Brainerd as his top economic advisor. Brainerd would replace outgoing National Economic Council Director Brian Deese. The appointment would see her work alongside another high-profile former Fed official, Treasury Secretary Janet Yellen, as key players in the administration's economic policy. Bloomberg has learned that a former Credit Suisse employee copied and took personal data from other staff members, including details of their compensation and bank account information. The company warned of the breach, which took place some years ago, in a letter to employees. The staff member had legitimate access to the data at the time and transferred it onto a personal device in breach of Credit Suisse policies. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Simone Foxman, and this is Bloomberg. Francine.
Simone, thanks so much. Coming up, how will the oil market fare in 2023? We found out what the UAE energy minister thinks. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, oil fell on a U.S. plan to sell more crude from its reserves, offsetting a gain from Russian output cuts and rising Chinese demand. Our Bloomberg Daybreak anchor Manus Krani spoke to the UAE Energy Minister, Suhail Al-Musrei, at the World Government Summit in Dubai. Now, he responded to concerns that China's reopening will throw the global oil market out of balance.
The decision that we took, the 2 million cut, has been effective in balancing the market and ensuring that there is enough supply. Now, you need also to be mindful. You need also to be mindful of the slowdown in the economy, of the fact that we're not getting the pace back to where we used to be before the pandemic in terms of economic growth across the globe.
So that's the global perspective, and here's what I want to get a sense from you. Many people have said to me, slow, low recession, soft landing. Is that now your base case scenario? Do you think the risk of a severe downside in the global economy is gone?
I think that's what we have been hearing from the experts, the IMF, the others. This year is going to be rather not an easy year, but they are not expecting to go back to normal. They're not expecting a rebound, and I think that's we take, and until something significant happen that changes that. We will have to take that as a base case.
What could be significant?
I mean, significance in terms of the demand rebound, and we haven't seen that. Actually, we have seen some growth in the inventories, which means that there is enough volumes in the market, and the price also is a testimony of the balance.
The other narrative is that there will be a deficit in the second half of the year. Given the inventory build, are you confident no deficit second half of 2023?
Well, I cannot say for sure, but the signs are that we are seeing they are balancing each other. There is growth in certain parts of the world compared to the lockdown in China, but there is also a slowdown in certain other parts of the world in terms of demand. Something I want to mention, there is also a reduction in the demand in Europe, for example, in energy in general. Because of the higher gas prices, people are becoming more conservative in their consumption. And I think that's a positive thing. That's something that is positive, and that is...
So it's a material slowdown in demand in Europe?
I think rather conservation in the energy use.
Now, overnight, breaking news, that's what we do. The Americans are preparing to release more oil from the SPR. Some OPEC members have in the past criticized this. Do you welcome an SPR release? Do you think it's necessary?
It's a decision of the United States. It's a sovereign decision. I'm not going to comment on that. What we will always make sure of is that the market is well balanced, and we will do our parts of the equation.
Well, that was Armanis Krani speaking to the UAE Energy Minister Suhail Al-Musri. The other story that we need to keep an eye on is TSMC. This is Taiwan Semiconductor Manufacturing, and it has just announced that it will increase investment in TSMC Arizona by up to $3.5 billion. So this is, well, not small in terms of investment. Earlier on, we did find out that revenue overall had increased 3.9% on the quarter. Now let's get straight to your Bloomberg Business Flash. Here's Simone Foxman in Doha. Hi, Simone.
Thanks, Francine. Ford is to cut about 3,800 jobs across Europe in the latest sign of industrial disruption caused by the sector's shift to electric vehicles. The U.S. car giant says about 2,300 positions will go in Germany and about 1,300 in the U.K. over the next 3 years. The company plans to go all electric in Europe by 2035. Gautam Adani's flagship firm has swung to a profit, with Adani Enterprises posting net income of 8.2 billion rupees for their latest quarter. The company reported a loss in the same period last year. This is as the Indian billionaire tries to win back investor confidence after a bruising report from a short seller wiped out more than $120 billion of his empire's market value. Bloomberg has learned Qatari investors are set to make an offer for Manchester United in the coming days. Sources say the Middle Eastern Sovereign Wealth Fund is helping with the consortium with preparations for a bid. The future of the English Premier League club has been the subject of a lot of speculation since its American owners were reported to be open to selling a stake. Global news, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Simone Foxman, and this is Bloomberg. Francine.
Yeah, we're so obsessed, Simone, with the football story. We did speak to the QA also in Davos. Now let's get straight to your stocks to watch with Joe Easton from our equities team. Joe, do you have anything Valentine's for me?
I do, Fran. I've got a Valentine's Day romance between Vodafone and Liberty Global. Liberty buying a 4.9% stake in Vodafone, the UK telecoms giant. They've been flirting for a while via some joint ventures. Get another Valentine's Day reference in there. This should spur some hope that the companies could potentially revive Vodafone's growth prospects. That stock up 3.5% in London, one of the best movers today, though Liberty warning they're not willing to go exclusive yet, won't be doing a full takeover. Then I'm moving over to Delivery Hero, of course the rival to Just Eat and also Deliveroo. This stock is down about 4.7% today as they issue around €1 billion in convertible bonds. That'll be used for potentially some small M&A and also to weather a slowdown in orders as the economy hits that recession. Analysts saying it doesn't look good that they're not able to generate that cash through their own business. Then I'm going to quickly go over to TUI, which is the dual-listed London and German travel company. They've got some really positive commentary on their recent bookings, saying that people are getting ahead on their summer vacations, getting those booked in, and are actually above pre-pandemic levels heading into the key spring and summer selling seasons. The final one, just quickly, is actually over in Germany as well. This is ThyssenKrupp, massive steel company. They're dropping today as their costs, their input costs in terms of iron ore, still weighing on their cash flow. Their earnings are expected to be below expectations in the next quarter. as some auto demand also weakens. Alongside those margin pressures, ThyssenKrupp down 8%, one of the biggest decliners in Europe today.
All right, Joe, thank you so much for bringing the Valentine Day puns. Our equities reporter, Joe Easton. Coming up, Credit Suisse making headlines again, this time from the data breach by a former employee. So we'll have all of the details next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bloomberg has learned that a former Credit Suisse employee copied and took personal data from other staff members, including details of their compensation and bank account information. The company warned of the breach, which took place some years ago, in a letter to employees. Well, joining us now is Bloomberg's Tom Metcalf. Tom, I don't know what, I mean, it's bad, and it's bad at any company if this happens, but it just feels so much worse for Credit Suisse because they've been in the headlines so long, right? How big a deal is this?
No, they just can't seem to catch a break. I mean, this obviously has nothing to do with their current troubles. And this, does seem to be a case of a kind of bad apple rogue employee at the time. But yeah, no, I think it just sort of feeds into this narrative, and it's just unhelpful, right? It's the last thing they wanted, sort of another kind of own goal. And really interesting to see, right now it does seem like it's been quite contained. I think the Swiss regulator is looking at it. Obviously, anything to do with personal data. I think there's some salary data in here. It's not great, but it is historic. I think it was sort of noted in 2021, and they've had to take this long before they could kind of notify anyone else. And I think the data refers to 2013, 2015. So should put all that in context. It's not kind of sort of systemic for them right now, but it's just very unfortunate.
So what does it tell us, Tom? First of all, talk to us about the breach. So if you put the breach into context, does it happen at other banks? Is it employee data or is it actual client data?
So what we understand from the statement is basically someone who was working at the bank and had access to this kind of data was somehow allowed to take it basically outside of the Credit Suisse network. And, I guess that's sort of a risk at, a lot of other places. We haven't seen something like this at many banks for quite a while. But yeah, it's one of those kind of inevitable, it's probably inevitable given how much data is out these days.
Very quickly, what's next for the bank?
Well, I think the things we're looking for is, I think in April they have a investor day or an AGM, and then come May, we're looking at Q1. So just whether they can kind of turn the ship around.
We'll be back in Zurich. Thank you so much, our Tom Metcalf there with the very latest on Credit Suisse. Don't forget to stay with us here on Bloomberg. Later today, 2:30 p.m. London time, we'll have an interview with the Richmond Fed President, Thomas Barking. It's going to be a very interesting conversation. Of course, we have a full roundup of that inflation figure a little bit later from the U.S. as well. This is Bloomberg.
We are still far from achieving price stability, and I expect that it will be necessary to further tighten monetary policy to bring down inflation down toward our goal.
It's about the labor market. The Fed is very concerned that the price increases are going to be sustained unless we really see a step down in the growth of the labor market.
If policy remains restrictive for longer, that soft landing very quickly starts to look like a hard landing.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. It's official. Japan's government formally nominates Kazuo Ueda to lead the BOJ, paving the way for a shift towards more hawkish policy. The yen gains. Countdown to US CPI, investors' position for today's crucial inflation report, while President Joe Biden is poised to name Lael Brainard as his top economic advisor. And automakers used to run plants at full tilt and sell cars for deep discounts. Now they're keeping inventories tight and prices high. Details on today's big take story ahead. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, you thought it was Valentine's Day. Actually, it is US Inflation Day.
Yes, well, happy Valentine's Day nonetheless, Anna. We are looking for an inflation print at 6.2%. That would follow a print from the previous month at 6.5%. If we get a big beat in terms of inflation, if inflation comes in higher than anticipated, many expect it to be a very risk-off day. If it's lower than anticipated, we could be off to the races. Take a look at U.S. futures right now. We're up about 0.1% after finishing the day higher yesterday. And I think investors were encouraged by data from the New York Fed that showed wage growth and inflation expectations are being held down, or they were held down in the last month of a survey that they did. And that is what's giving investors a little bit more confidence that we could see a good print today. The U.S. 10-year yield at 369.78, so coming down from where we saw it yesterday. We were up over 370 yesterday. And the Bloomberg Dollar Index also softening a little bit right now. We're off 0.25%. You can see gains in the pound, I know, against the dollar, gains in the euro against the dollar, and we'll check the yen in just one moment. Bitcoin right now at 21,819. It is gaining, and this has become such a risk indicator that if we see stocks move higher, you're almost guaranteed to see Bitcoin move higher as well. The same is true vice versa. Take a look at what's going on in Asia and how we finished the session there overnight. The MSCI Asia Pacific, the broad index, was higher by 0.6%. I note that we saw bigger than usual gains in India. The Sensex up, closing up about 1 full percent, and the Nikkei also closing up about 2/3%, at 27,600. You can see the U.S. dollar weakening against the yen. It can buy 132 yen, though we did hear Mr. Yen in Japan say that it could be strengthening. You could see the yen strengthen to 120 if Ueda is able to raise rates, something I'm sure we'll talk about throughout the program and throughout the day. What do you see in Europe, Anna?
Yeah, absolutely. We'll have more analysis on that Japan story a little later in the programme. This is the European picture then, Matt. Pretty positive. As we see US futures recover from earlier losses, that helps Europe secure these modest gains that we're making across European equity markets, up around 0.5% on the London market, 0.4%, 0.2% for other major markets. It's pretty broad-based. We see all sectors in Europe in the early hour of trading here, all sectors in positive territory. That seems to be a fairly broad picture of gains. The best performing sector, though, has been around the telecom space. Vodafone, the telecom operator here in the UK, up by 3.6%. Of course, it operates far and wide beyond the UK's borders. But we've seen Liberty Global taking a stake in this business. They've said they don't want to go for a full takeover, but does this pile pressure on the team at Vodafone to shore up the management ranks? TUI is up by 2.6%. Revenge tourism seems to be the thing there. Summer bookings running at higher than 2019 levels. And so that seems to be well received by many analysts, at least, giving this a positive take, not all. The pound is at 121.95. Matt, to your point, dollar weakness, pound strength, euro strength. It's a dollar story, perhaps, really. But we also had some data out from the UK here, which continues to confirm the tightness of the labour market. 3.7% is the rate of unemployment we have here in the UK. And if you exclude bonuses, we're talking about a rate of wage growth that came in higher than had been anticipated. That's something that is certainly on the Bank of England's radar. And here's Brent crude, 85.81. Things in the mix here. We've seen, of course, that announcement from the US government about the Strategic Petroleum Reserve. They are releasing, even if they hadn't really wanted to right now, having to release some because it was pre-planned. But we've seen that in the mix, but also they didn't have too much of an impact on prices, to be fair. We've also heard from the UAE energy minister then, Matt, talking about how they are pretty happy with the level of production from OPEC+.
Right. The concern is that that just reduces the amount we have in case of emergencies or in case some political party needs to win votes. So they wanted to avoid that, but there was a 2015 law that forced them to continue to sell off the Strategic Petroleum Reserves. Let's get, though, over to Japan right now. That country has officially nominated Kazuo Ueda to lead the BOJ, a move likely to pave the way for a gradual paring back of the central bank stimulus. Aisuke Sakakibara, former Japanese vice finance minister, he is more easily called Mr. Yen, spoke with Bloomberg on what to expect from Ueda's leadership.
He may change his policy if the Japanese economy gets overheated, which is expected at this moment. He might, be in a position to tighten the monetary policy rather than continuing to ease the monetary policy.
Paul Jackson is Bloomberg's economy editor for Japan. He joins us now live from Tokyo. So, Paul, thanks so much for coming on the program. How quickly are we expecting the change to come at the BOJ? I know Mr. Yen's forecast had to do with rates being raised by the fourth quarter.
Well, that's the key question everyone wants to know. We do expect eventual change during his 5-year tenure. But the comments that Mr. Ueda made on Friday, when the news kind of broke that he was going to be the surprise choice to lead the central bank, the yen strengthened sharply to about 129.81, and he came out with a comment saying that current BOJ policy was appropriate and stimulus was needed to continue for the time being. So, you know, that doesn't sound to me like someone who's in a terrible rush to change or pivot on policy. So I don't think he, in his first meeting at the end of April, I don't think that's presuming, of course, he's confirmed by Parliament, which we expect. I don't think he's going to come out all guns blazing like Kuroda did 10 years ago when he fired off his bazooka stimulus. I think he's going to be a more kind of thought-through process.
OK, yeah, there are certainly a lot of different views on this, aren't there, Paul? We talked to a guest from Union Bancaire earlier who was saying they do think there will be some movement in April. Others, such as Mr. Yen, saying no movement till October. We have a guest coming up later in the programme who says any moves will be really gradual anyway. Now, what more do we know about Ueda, or when will we know more? I know he's going to be facing parliamentary scrutiny on the 24th of February.
That's right. So he's going to be quizzed on all his views then. So I think we'll get a better idea as to, you know, whether he's hinting at change to come quickly or not. Of course, one of the really difficult things with this is they've got this yield cap in place. They've got speculators fighting against this yield cap. Is that if you give a hint that you're going to do something, then that's going to invite a whole wave of speculation. So how much kind of forward guidance can you give on change to come? So you might have to have a kind of surprise move. And if you remember, we did see in December the BOJ throw a surprise at us. And we also saw how that jolted markets globally.
Paul, thanks so much for joining us. Your evening time. Paul Jackson reporting live from Tokyo for us on the Bank of Japan confirmation. Now, sticking with, in a way, central banks, at least something that they're going to be watching very closely. Today's U.S. CPI report is expected to show costs rising briskly from the prior month, indicating the path to price stability sought by the Fed will be bumpy. Valerie Teitel, Bloomberg Markets reporter, joins us now for more. So, Valerie, we're looking for 6.2%. Still better than what we saw the month before, but still, I guess, too high for the Fed or any central bank around the world.
Yeah, too high for the Fed, but really the attention's going to be on these month-on-month numbers, Matt. The pressure on these data prints has just gotten so gigantic, we're even going to care about the second decimal place on these month-on-month numbers. Now, the core month-on-month and the headline month-on-month are expected to show some tick up from last month's print. I want to note that Bloomberg Economics sees a risk that these prints can come in hot today. That's driven by energy inflation, driven by slowing growth of disinflation in core goods, and a pickup in services inflation. But look, I had some clear excitement this morning when I found out I could now officially chart core services ex-housing inflation. Bloomberg has now made these tickers from the BLS data set. This is where my eye is going to go, Matt. Powell has spoken extensively about this component of inflation, that's core services ex-housing. It creates 56% of the core print, and his worry is that a tight labor market could keep this sticky for too long.
OK, you have to get in touch with the Fed chair. Send him the tickers. I'm sure he'll be grateful, Valerie. Now, President Biden is said to name Vice Chair Lael Brainard as his top economic advisor. Is that going to leave a hole at the Fed? What does that mean?
Yeah, that's the big concern. She's long seen as the top contender for this White House post, but it goes without saying she is the most influential dove at the Fed. She sits within Powell's inner circle, and she helps set the agenda for their policy meeting. When she moves on, who is going to replace her? It's going to be likely someone without her caliber and without her influence. Biden is to nominate her successor, but it's unclear who and it's unclear when. She has been previously considered for Treasury Secretary and the Fed chair by Biden recently, but she was passed over. The speculation is that she would take this role on the Economic Council, and if Biden wins re-election, she could be up to succeed Yellen as the Secretary chair in the future.
All right, very interesting stuff indeed. Valerie, thanks so much for joining us. Bloomberg's Valerie Teitel there with a look at CPI as well as a new role for Brainerd. Don't miss our exclusive interview, by the way, speaking of the Fed, with the Richmond president, Tom Barkin. That's right after the CPI report at 9:30 a.m. New York time, 2:30 p.m. in London with our own Michael McKee. Now, to a Bloomberg scoop, Tesla workers in Buffalo are launching a unionization campaign. This could be the first union at the EV maker and a new blow for the CEO, Elon Musk. Joining us now for more is Bloomberg's Global Autos editor, Craig Trudell. So, Craig, what does Tesla do in Buffalo, and what does unionization mean for Tesla Buffalo?
Yeah, this applies specifically to data labeling folks at Tesla's Buffalo facility. This is famously where they do work on solar products, and actually has been, kind of a controversial facility for them in the sense that they really needed to hit certain employment numbers in order to sort of, receive some of the state support that was lined up for them to build the factory there. It took them longer than expected to reach that. And it's also interesting, just this unionization drive in light of the fact that there have been some job cuts to specifically these types of workers recently. This is something that the company is trying to automate over time, and no longer have as much human involvement in labeling the data that they use to sort of improve and build upon autopilot and the system that they market as full self-driving.
Yeah, interesting. Watching the automation of the autopilots, which is what we're talking about here. Good morning, Craig. So today's big take story also talking about the auto sector, talking about car prices at record levels, the shift to EVs. How is that impacting on pricing? What's driving auto pricing at the moment?
Yeah, great story from David Welch and Keith Naughton in Detroit. This is a story that, is a few years in the making. The semiconductor shortage obviously playing a big role here, but I think interestingly we've heard CEOs, Mary Barr at GM, Jim Farley at Ford, talk about the idea that this is going to lead to lasting change for the industry, that they're going to be more disciplined in terms of inventory. This has always been an industry, and particularly for the Detroit car makers, where you've carried a lot of inventory that's led to carrying costs for you and your dealers. And a lot of discounting has affected the profitability of these companies. I think there's some skepticism as to just how long that actually will last, that discipline. But absolutely what we've seen really since 2019 is car prices just skyrocketing, and we've captured that in a really detailed way.
Yeah, a very cool story indeed. Craig, thanks so much for joining us. Craig Trudell there. He leads our global autos coverage. And shout out to David Welch and Keith Naughton for writing that big take story. Highly recommend you check that out on the terminal. In other autos news, by the way, out of Detroit, Ford plans to cut 3,800 jobs. Actually, I should say this is for European jobs over the next 3 years. Workers in the UK and Germany will be the hardest hit. It's the latest sign of industrial disruption caused by the shift to electric vehicles, and that has a lot to do, that shift, with the big take story as well. So all of it tied in together. Highly recommend, again, that you check that out. Now, let's get a look at some of the stocks, other stocks that we're watching in pre-market trading this morning. Palantir is one of them. The technologies, the data analysis company that was co-founded by Peter Thiel, said it earned 1 penny per share during the fourth quarter under GAAP accounting. So 1 penny doesn't sound like a lot, but number one, it beats the expectations of a loss by an infinite amount. It also is the first time that Palantir has ever posted a profit for a quarter or a full year. So first ever profit. They say they're going to post a profit for 2023. As you can see, the shares are up 17%. in the pre-market trade. Also, speaking of solar, we were talking about what Tesla does in Buffalo. Solar Edge, which makes inverters, had profit and revenue that both beat analyst estimates by a long shot. And Bloomberg Intelligence says the fact that they're growing so quickly, faster than most of their peers, means that they may raise their full year forecast for 2023. And nonetheless, the shares are off 5% in the pre-market. They've done pretty well so far this year. They're up 10% year to date, and they're up in the past 12 months more than 20%. So maybe there's a little bit of buy the rumor, sell the news going on here. Anna?
Interesting pre-market movers there. Coming up on the programme, we'll get back to the macro. Azhar Hussain joins us, head of global credit at Royal London Asset Management. How are credit managers preparing for that CPI print out of the US later? We'll talk about the big BOJ announcements as well. We'll talk to Shigeto Nagai, head of Japan economics at Oxford Economics. What is the expectation around the new governor? Plus, Northvolt joins a host of European companies putting Brussels on high alert over the lure of massive US green tech incentives. CEO of Northvolt, Peter Carlson, told Bloomberg why the Swedish battery maker would benefit from producing in North America.
If we would start tomorrow building a factory the size of Northvolt 1 up in Skellefteå, fully built out in North America, to be ready by 2026, between 2026 and 2030, we would be looking at somewhere between $7 to $8 billion in these credits.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller in New York with Anna Edwards in London. Now, traders are preparing for an inflation print with hedging the downside possibilities against the downside possibilities on the S&P 500 right now. Of course, if we get a print that's stronger than the 6.2% that is forecast in our survey, you could see a real hit to risk assets. If we get a print that's much lower than that, we could be off to the races. Joining us now to talk about both of those possibilities and what Wall Street expects in terms of reaction is Denitsa Tsakova, Bloomberg cross-asset reporter. So, Denitsa, what do you expect to see given either outcome?
Yeah, for sure. So, as you said, we've seen a big spike in hedging, especially the cost of hedges against a 10% decline in the S&P. And this kind of makes sense with how big of a move we've get. But as we've said many times last year and apparently this year, this is one of the most anticipated prints because we've seen 3 consecutive prints that showed disinflation and falling inflation. This time, actually, it's expected for the print to come a little bit hotter than previously thought, 0.5% monthly increase, which will be the biggest in 3 months. What are traders expecting? Like, we've seen some significant repricing in terms of Fed funds rate. That 5% terminal rate is more expected than it was before. If we look at break-evens, they've definitely repriced higher. We've seen hedging. If you look at 2 years Treasury yields, they've been soaring over the past 2 weeks. And going back to that motto, we may see really big price swings today. We can go up to 3% if we see much cooler than that 6.2% annual increase. But we can really go for a big 3% slump if the print comes hotter than expected.
And Denitsa, the reason this is so in focus is there's precedent for this. You know, we often see big moves in risk assets on CPI day. That's been a trend of late.
Yeah, it's been in the trade. What is different lately is that jobs report, which kind of changed a lot of things for investors because everything was moving in a trend. You know, the job market, there was disinflation, and now everyone's like, can this lead to higher inflation? Also, obviously, gasoline prices have been a big factor. We've seen used cars, and a lot of investors are worried. But what is different this time is we are obviously at a low positioning, but we're not where we were in mid-October. Like, bets were very bearish. There were big short bets, big underweights. And, of course, no one is bullish now. But there isn't the force for that much big of a short covering, which actually may be bad for markets.
markets, because before we saw trend followers coming in, buying into the rally, and this may be missing this time.
We'll see what happens. Thank you very much, Bloomberg's Denitsa Sikova. And for more market analysis, MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Sell insurance or something?
Welcome back to Bloomberg Surveillance Early Edition with Matt Miller and Anna Edwards. Coming up on the programme, we'll talk about what to expect from the inflation print out of the US later today. Azhar Hussain joins us, head of global credit at Royal London Asset Management. If we get that hot number driven by energy and services, what does that mean? If we factor in a higher rates environment, what will that mean for corporate credit? Lots to discuss. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's official. Japan's government formally nominates Kazuo Ueda to lead the BOJ, paving the way for a shift towards more hawkish policy. The yen gains. Countdown to US CPI. Investors positioned for today's crucial inflation report, while President Joe Biden is poised to name Lael Brainard as his top economic advisor. And automakers used to run plants at full tilt and sell cars for deep discounts. Now they're keeping inventories tight and prices high. You can read all about that story in today's Big Take. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it is inflation day. We're working our way towards that. I was going to say not much big move, but we got decent gains actually on European stocks this morning.
Yeah, and we had some pretty big moves in the markets, U.S. markets yesterday. It was really interesting on a little bit lighter volume than you typically see. Moves of more than 1%, or gains of more than 1%, I should say, on the Dow, the S&P, and the NASDAQ. So investors took some data they got from a New York Fed survey showing that consumers aren't expecting wage growth, aren't expecting higher inflation a year out, and bought the market and bid it up to 41.37 on the S&P. You can see we're higher in futures now as well, 0.2% on S&P futures, the E-mini contracts, to 41.55. So investors continue to bid this market up into the data that comes out at 8:30, which is in just 3 hours' time from now. The U.S. 10-year yield coming down, so investors are buying some of those bonds. The yield is lower than it was at this point yesterday. We saw it, I think, 373. Right now we're at 369.40, and you also see some dollar weakness, which should be good for risk assets as well. So the Bloomberg U.S. Dollar Index coming down as the greenback falls against the yen, the pound, the euro, you name it. Bitcoin is also gaining against the dollar. Right now, it's still under 21,000, but it's up $188 to 21,819, and it has been a real risk indicator. So it looks like risk on until we get that number, of course, and then it's anybody's guess, depending on which side of the survey it falls. We're expecting 6.2% at 8:30. If it's more, we could have a problem in terms of risk assets. If it's less, we could be headed further higher. Take a look at some of the pre-market movers. Palantir is a giant gainer in the pre-market. It is the data analysis company, the big data company founded by Peter Thiel. Said it earned 1 penny per share in the fourth quarter. We were looking for a loss like every other quarter in Palantir's history. They've never posted a quarterly profit. So this is the first quarterly profit. They say they're going to have a profit for the full year, and as a result, the shares are up almost 18% in the pre-market. Now, SolarEdge is a different story. This is a $17 billion solar inverter for solar panels. It's one of the leading companies in that area. Bloomberg Intelligence says it's growing faster than its peers, faster than the industry. It beat on profit. It beat on sales by a long shot in both cases, and it has a higher than anticipated sales band forecast for 2023. Nonetheless, the shares are off 5%. So maybe it's a case of buy on the rumor, sell on the news, because this is a stock that's done pretty well year to date, up 10%, and over the past 12 months, up 20 to 25%. So it's been doing quite well, and now it's selling off. Anna, what do you see in terms of European stocks right now?
Yeah, doing quite well, I suppose, here on European stocks then, Matt. We're up by 0.5% on the Stocks Europe 600. Pretty broad-based, most sectors in Europe in positive territory. The telecom sector doing really well. Vodafone is a big player in that sector and leads those gains, or at least is near the top of the pack, up by 4.1% right now. Liberty Global taking a stake in Vodafone, saying they don't want to go for a full bid, but this does put pressure on the company to shore up some of the management changes and decisions they need to make. The pound at 121.93, up by 0.4%. Matt, as you were saying, this are really a lot to do with dollar weakness rather than necessarily pound strength, as we see the yen and the euro also gain. But we've also had some jobs data out from the UK. We get inflation data this week from the UK as well. The job story still showing very tight labour markets, 3.7% unemployment, and wage data excluding bonuses that came in ahead of estimates. Brent crude at 85.62, down by 1.1%. We've had a release from the SPR. That's part of the story. But we spoke, our colleague Manus Cranney talking to the UAE energy minister, saying he's happy with where OPEC is in terms of production right now, Matt.
All right, we will keep a close eye on Brent and the other commodities right now. But, of course, CPI is front and center today. Joining us to talk more about that is Azhar Hussain, head of global credit at Royal London Asset Management. And Azhar, of course, this touches credit assets around the globe, what we see from U.S. inflation today. What are you expecting, and how important is the number?
Well, it's going to be a very noisy number, unfortunately. So I think we might have a bit of an overreaction. I think what we kind of have to take a step back and say, look, inflation's down quite considerably from where it was. And interest rates are much higher than they were as well. I think that direction might have a bit of a blip. I think, I don't think we're going to get to 2% in a straight line. And in fact, I think, the market's probably got a little bit ahead of themselves in the last few weeks in thinking that we're rapidly deflating away. So I do expect a bit of a re-blip, in terms of us, whether it's in this number or whether it's next month's number. I think, there's enough data out there that we're going to probably stabilise at a slightly higher level, which ultimately means that the Fed are going to have to stay higher for longer.
Yeah, Azhar, very nice to see you. Thanks for coming in today in London. So you say it's going to be noisy, and a lot of people focus on, we might see a slowdown in the rate of decrease in inflation, and maybe that'll provide some reason for caution. I know JP Morgan were putting out some numbers about what kind of stock gains or selling we might see as a result of various numbers on inflation. What do credit markets look like then in the face of, say, higher than 6.5% or lower than 6%?
I think on a similar sort of magnitude, I think we could get a 20 or 30 basis point move in high yield markets, either direction based on the number, which is quite significant. But then again, if you just dial back 5 or 6 weeks, we've already tightened quite considerably from the beginning of the year. So we're still going to be the absolute yield is going to be much lower than it was at the start of the year, and spreads are still tighter than they were at the start of the year.
Yeah, and in terms of that, it's high yield spreads, I know, and you've said in your notes, look quite tight if a recession hits. I don't know whether you think that we are going to see a recession, but if we are, what should those high yield numbers look like, or what are they telling you we are going to see on the recession side?
And I think what it's telling you as well is that the recession, the nature of the recession that will hit is going to be very different from the recessions we've seen over the last decade.
Because of relative balance sheet strength, is that the differentiator?
Absolutely. The underlying is very, very different. The composition of the market is very different. It's a much larger market, but these are much bigger companies as well. So that means ultimately, I think, what really matters, defaults are going to be lower. And that's really significant because, if you dial back a year, people were forecasting high single-digit, even double-digit defaults possibly in the high-yield markets. I think that number's going to come as low as 3% possibly this year. But certainly low single digits is where it's going to come.
It brings up an interesting question, Azhar, and I note that you studied economics and political science at the LSE. On the other hand, as a chartered accountant, you adhere to really fundamental, kind of bottoms-up research when it comes to picking credits. So what do you make of this kind of macro-driven world? It seems that central bank policy is the only thing that matters right now.
I think it's always been the case. Macro does drive fund flows, and the technicals are very significant ultimately. And we're going to get volatility along the way because of the technicals. But over a sort of a longer period, and what I mean is 12 to 18 months, the fundamentals usually shine through pretty quickly, particularly in credit markets, because what you're really, particularly in high yield, you're really trying to work out, is the company going to make it or not? Are you going to get your bonds paid back or not? And that's why that default rate really matters, and what that future default rate looks like. And that's where, you know, you can have a lot more confidence by just digging into the composition of these markets from a bottom-up perspective, because they look very different to what they did even 10 years ago.
OK, so this is a different kind of recession, even if we get one, and you know, a lot of people think we might not. Let's leave it there, Azhar. Thank you very much. Azhar Hussain of Royal London Asset Management. Thank you for bringing us your thoughts. Coming up on the programme, we'll talk about Japan. Shigeto Nagai joins us, head of Japan economics at Oxford Economics. What does he make of expectations around Ueda, whether he really is going to be as hawkish as perhaps the knee-jerk reaction in the markets had suggested back on Friday? We'll learn a lot more this month. What does he have to say? This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Harvard University Professor Ken Rogoff. That's at 8:30 a.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, the Japanese government has formally nominated Kazuo Ueda to take the helm at the Bank of Japan. The university professor and former BOJ board member will take over from current Governor Haruhiko Kuroda when his term expires in April. Joining us now from Tokyo to talk about what this means for the bank, what this means for financial assets, is Shigeto Nagai, head of Japan economics at Oxford Economics. And Shigeto, thanks so much for joining us. It's interesting as we see the yield curve control starting to loosen, that we get a new name here. What do you expect in terms of how he carries forward Kuroda's policies?
I think he will try to adjust the current easing framework in order to reduce some side effects, and especially this YCC policy. But at the same time, it's important to know that Ueda-san will also continue the ongoing, very accommodative monetary policy at the same time.
But the interesting thing is, while you think that this yield curve control policy is too aggressive, and I guess the Kishida government as well is concerned about side effects. Maybe Ueda is as well. So do they agree, the government and the BOJ, on a mission and go forward with Ueda?
Yes, I believe so. I think the recent nomination process shows that Kishida administration is really determined to make some adjustments to the current framework, especially on this YCC front. I think they will somewhat make adjustments to allow the JGB market itself to formulate the yield curve in the coming period.
That's interesting, Shigeto. It's Anna in London. Good morning to you. Interesting, you're talking about then tweaking yield curve control, not moving away from it. And there are some people who are expecting much more radical change. Why do you think there isn't the appetite to be more radical on that front?
I think it's more likely that they will somewhat widen the band in the coming period, in a relatively near future. But at the same time, I believe they will keep a certain range of band, because the coming process of exit from the, especially QE policy in the coming period, is very sensitive and a very delicate process. So the governments, the last thing they would like to see is the market disruptions caused by this exit policy. So they will keep some safeguards or the defense line in this long-term yields. That's my view.
OK, so it's a delicate process. Market disruptions are possible, of course. I wonder what the underlying inflation dynamics look like, Shigeto. And if we are seeing a very pragmatic BOJ governor who's going to make decisions based on the underlying economics, where does that underlying economics steer us? Because I was looking, my colleague Mark Cudmore drew this to my attention, so many different measures of Japanese inflation, some of which suggest that inflation has really overshot the target, and other measures, if you exclude if you exclude all food and energy and drink and all kinds of things, suggesting that we haven't hit the targets yet. So what's your assessment?
I think the current overshooting of inflation is just transitory, and the inflation rate is projected to decline, especially in the second half of this year and the year next, simply because the wage developments will continue to be stagnant, and because of this weak demand, the company haven't really regained their pricing power yet.
So in terms of the effect this is going to have on global assets, Shigeto, I wonder if it's just going to continue to draw money back to Japan. That's what we've seen in the recent past, and I know that Japanese investors have, for example, more than $2 trillion invested in global bond markets. Do you see that continuing?
I think what we will see very likely is that some adjustment in the long end of the yield curve, say the 10-year yields could rise, say, close to 1% or 80 basis points. But the important things to note is that Ueda-san will continue a very accommodative monetary policy by maintaining short-term policy rates at around zero. Even if they get rid of negative rates, the rate will remain very close to zero because of these stagnant demand conditions. So there's going to be a little difference to interest rate differentials internationally, which really determine the global capital flows. That's my view.
What does it mean for the very popular carry trade? Is it going to continue to be possible for, hedge funds to fund their bets by selling yen or selling JGBs?
I think Japan may regain its status as a kind of global funding currencies for taking risks globally, because Japan continues to be the only country with nearly zero interest rate in that sense. I think this kind of carry trade trend will come back, and Japan will continue to be the source of global liquidity funding, I guess.
Okay, so not such change expected then, perhaps, on that front in terms of continuing to be that global funding currency. What about the style of Ueda, Shigeto? What should we prepare ourselves for? This is someone who I know Larry Summers has described as the Japanese Ben Bernanke. I mean, they have some education and some training in common, I think. How should we expect to see him communicate with global markets?
I think he's well experienced because of his background. So he will make a kind of comprehensive review of the current policy, taking at least a few months, and trying to explain all the changes using his own words. And I think the most challenging is whether the financial market pressure will allow him to take such a long time. And I think that's where this possible widening of the band of the YCC target will come earlier than this formal decision after comprehensive review.
Shigeto, thank you very much. Shigeto Nagai of Oxford Economics, thank you very much for giving us your thoughts. Coming up on the programme, US inflation data is due at 8:30 a.m. New York time. Of course, we've been talking about that a lot. We will get a further preview of what we should expect next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, a look ahead to what is ahead today. At 8:30 a.m. Eastern Time, we will get that crucial US CPI report. The report comes as several officials from the Fed hold speaking engagements today. We heard from one overnight from the Fed's Bowman, of course. Now, Richmond Fed President Thomas Barkin speaks exclusively on Bloomberg TV at 9:30 a.m. Dallas Fed President Lori Logan takes part in a moderated discussion at 11 a.m. We will also hear from Philadelphia Fed President Patrick Harker, and New York Fed President John Williams wraps it up with a keynote speech at an event hosted by the New York Bankers Association. So if the Fed then, Matt, wants to give a different message to the markets, if it wants to throw in a new interpretation of the CPI trends, it will have ample opportunity.
Yeah, well, absolutely. And it'll be great to hear from Barkin a little bit later on. I believe that is an exclusive interview. So actually, I have the person who's going to lead it to ask here. Michael McKee joins us on set to preview the CPI report, to tell us what questions he's going to ask Barkin. He's Bloomberg's international economics and policy correspondent. Mike, I guess first of all, what do you expect from this number? What are investors going to be paying most closely attention to?
Well, it depends on where you're sitting, what you'll see. The average person, and maybe many on Wall Street, are going to look at the year-over-year numbers, which are going to come down and show continued progress on inflation. The Fed, though, is going to be focused on the sequential changes month over month to see if we still are making progress, and there the news is going to be more disappointing, with headline going up 0.5%, according to the Bloomberg Consensus Survey, and the core going up 0.4. They had already been revised, and this is something people may have missed. Seasonal adjustment changes made by the Bureau of Labor Statistics pushed both of those up 0.1 and into positive territory for the headline number for December from a negative, and the core rate was raised as well. So we're coming at it from a already higher inflation level. Now, a lot of experts say that'll wash out over the coming months. So has that gotten into the market? That's the question. Do people think that this is going to get better, or are we going to see a surprise reaction?
And what are we expecting to be the reaction, Mike, good morning to you, from the Federal Reserve? Some people are linking the fact that we didn't see the Fed really rattled by that hot print on jobs, and therefore suggesting that maybe that dulls any assessment of the link between a beat on inflation and higher rates. What's your thinking about the sort of Fed reaction if we did get a hot number?
Well, what analysts are saying at this point is that inflation is going to come in hot for the month of January. It's not related to higher wages and probably not as connected to service industry prices as the Fed worries about. So they'll anticipate a reversion in February, see it come back down a little bit, which probably means we'll generally hear from the Fed today what we've heard from them before. The idea that they are going to raise rates a couple more times and they're going to leave them there. I don't expect a major change in policy yet. Now, if we get a second CPI along those lines, we may have a change in their views, but not today.
Valerie wants to know if you're excited about the new tickerization of, what is it, core services, ex-housing. And I think it's interesting, you know, the nuance is interesting, because I got a message from a trader today, Anthony Santos Stefano. He says, maybe we'll see an underreaction because many know the methodology is changing, and they may need time to sort through any murky, abnormal print, which makes sense to me. Everybody's looking at these little nuanced readings, right?
Yeah, it's been a long time since anybody did that for CPI. But the tickerization of this new, what they call super core, which is services ex-housing, is a response to Jay Powell, who has said that right now we think goods prices are going down, and that's okay. And we know that housing prices will go down eventually. Energy prices we can't control, but service prices are made up largely of wages, and if wages are still going up, that's going to push up service prices. So we want to isolate that aspect of the CPI, and so now we're all watching that, and you can bet at 8:30 we'll be talking about that.
And at 9:30 as well.
And at 9:30 we will be talking with Tom Barkin.
All right, Mike, thanks so much. Michael McKee there. Don't miss his exclusive interview with Richmond Fed President Tom Barkin. That's at 9:30. So 1 hour after the 8:30 CPI print, we get Richmond Fed President Tom Barkin coming on to talk to Mike McKee. That's it for Early Edition. Surveillance is up next. In that program, we're going to hear from Harvard University professor Ken Rogoff, among others. This is Bloomberg. Oh, happy Valentine's Day.